Good afternoon. This is the Elliott wave update, since I haven't done one in quite a while, on the Treasuries, in particular the 30-year Treasury bond and the 10-year Treasury note. And it's being recorded on Sunday, April the 6th at 1:45 p.m. Pacific Daylight Time. And I've chosen to update these because they suddenly are back in the spotlight. And we saw last week as the markets were really tipping over the edge that the treasuries put in a pretty strong 2-day rally, at least the 30 and the 10-year note. And of course, we have the president basically harping on Fed chairman to lower interest rates, lower interest rates. And the problem is that the Fed, in their statements last week, were basically saying back to the White House, the Federal Reserve Bank, the Federal Operating Market Committee, the FOMC, is an independent group, independent of the federal government. And while they might have a say in who actually becomes the the chairman of the Federal Reserve, they really don't have any influence other than banter. So, but what I might say is that, Mr. President, understandably, that's what you'd like. Stand back and let the market do it for you. And what I mean by that is how I'm going to update this right now. Now, this is a 5-year weekly chart where I can show that high back in 2020, August of 2020, when the 30-year bond was 1.19%, where the 10-year note was 0.69%. That's what you got if you gave the government $2 million on a 10-year note. You got 0.69% interest. Well, that proved to be a pretty strong top. We then went through a very long period up to and including down to October of 2023, where the bond market bottomed as rates were really jumping. They were going. And we saw some very hard selling and we saw some very strange moves. And the Fed then, if we remember that time, that actually made the call in October of 2022 that the equity markets were very, very oversold and that interest rates really had to start coming down. Now, that took a while longer, but it did happen. It did happen. We've seen a very stringent program by the Fed to reach its targets, its inflation targets, et cetera. And what now our president is trying to say, we need those lower interest rates or the economy is really going to just tank. It's like, well, what we need is to not have a president who insists on building up inflation, who insists on having inflationary policy, who insists upon doing things that are not going to benefit the citizens of the country, who are the ones paying for these products that now have huge tariffs placed upon them. So stop doing that, and the market will do the balance for you. And you'll get your wish of lower interest rates. Let me show you the Elliott picture, which really has not changed. So here we have, there's a primary. That's the largest degree that actually can count. I need to go out and search around to see how much higher what I want to put above that primary degree. Is there a cycle degree that would come in up there and show that we've got a whole lot of correcting to do before we get to that next stage of super low interest rates? So right now, I do believe, yes, we came down. We're now working our way back up. Remember, higher rates, higher bond prices, lower yield. See the inversion? See the conversion there? Higher bond prices, higher 10-year note prices, lower yield on that bond. When the bond market sinks like a stone, the yields are going up. And so often we'll see it's like, why are they jumping in and buying those bonds? Because they're trying to lock in that yield. Because these things get auctioned, just like everything else. There are auctions. And so there are a lot of hedge funds, there are a lot of very large banks and et cetera, that they will lock up money for 30 years or 10 years. The problem last time, folks, the banking crisis that we had with Silicon Valley Bank, with First Republic Bank, and a lot of the others, the reason behind that is that they were buying these 10-year notes with minuscule interest, and then they weren't hedging. They didn't hedge the trade. And what happened? Interest rates went up substantially and rapidly to knock out inflation, which was occurring. And those trades were not hedged. So they had no protection against a higher rate. And that's what we got. And it destroyed those positions and bankrupted the bank. They had to run. We want our money. Obviously, you're not doing so well. And it's because of the trades. It's because of these trades in this 10-year note. So the Fed continues to watch this 10-year and the 30-year. So back to the 30-year. We came down in 5. I'm labeling it intermediate to intermediate A. So we've been in an intermediate B wave from October of 2023. What's going to be inside this intermediate wave B? An ABC of minor degree. Well, we had the A wave. I thought, okay, we're going to do the B wave. And then we had basically an A, a B, and a C. So the minor B wave ended here because initially, right, I'm running my fibs here. I've been looking for a run back up to 135 to 144. Those are the fib resistance levels for the intermediate B wave. Well, we're sitting down here and having a problem, then we start to decline again. So remember, bond prices lower, yield higher. So the yields are starting to climb back up again, 4.5, 4.6, 4.7. And I was like, wow, okay, so is this all? This is the A, this is the B, and we're dropping in a C wave? Could have been. Then we had this. And again, if we take a look at what took place, that if this could be A, and it is A, and I'm marking it as A, and then you got an a B in a regular, and then a C. So it's the minor B wave of intermediate wave B. So what did we kick off with here? So we started to rally, came back down, rallied strongly Thursday, Friday. What is it telling us? Well, C wave, if we're just going to keep it on an Elliott wave basis, we're likely in the C wave. And if I had to, I might just kind of go 1, 2, 3, 4, maybe, or just 1 here, 2 here, and we're now starting a third wave, certainly kicking off like a third wave, right? Where you just go bang, 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 bang. You just absolutely, whether it's up or down, it moves fast. It just gets up and it goes. That's pretty much what the bond market did. So maybe we are in wave 3 of C. Now we have some fib levels coming up. That's for the entire C wave. We have 122.07, that's 0.618. We absolutely almost got there. The high was 121.27. We're looking at for 22.07. So maybe we get a little bit, we get up there, maybe we pull back a little bit. Or this was it, and we pull back a little bit, and then we continue on the rally. So once we're back underway, I'm still looking for. So what does this also tell us, right? If we're looking at that the bond market was reacting to the death spiral in the equity markets, could we actually start doing that again? Will we drop into another death spiral? Yeah, if you've been listening to my stuff over on the S&P and the NASDAQ and the Dow and the Russell, all of them still can have additional downside. And we don't know yet if it's going to get bumped up a degree, which makes it real ugly to the downside. So yes, the bond market can react very sweetly and end up putting in a new high, at least for the sequence, right? So far, we've only been up to 127.22. I think minimally, guys, I think you got to get at least up to 135. So when it wasn't happening, you begin to question what's behind it, what's kind of going on. And we were having trouble here and there. Now, what's going to really damage this? Inflation. Inflation. You battle inflation, you're going to have to continue to lower, but you can't too much because it just gets twisted and complicated. So in a battle of inflation, you have to take the money out of their hands. So when things are calm and we need to stimulate, we're going to put money into everybody's hands. How does that happen? Well, lower rates. So we're out there buying cars, we're out there buying houses, we're out there buying clothes, we're out there spending money. Right now, panic, get your money back in your own hands. You don't know what's going to go on in the stock market. Nobody wants to spend it right now. So, so yes, lower interest rates will begin to ease the mind. But the thing to remember is that the market can do that for us. The Fed has not bumped off of their stance that they're going to stick to the plan. And the plan is to get inflation down to 2% or lower. Great. Do that. And if you can hold it there, then we'll be chugging on all cylinders. Until that happens, I think we can just really flounder around a little bit. But if I'm going to stick to the Elliott count, I think we're in a minor C wave up to complete the intermediate wave B. This is a very long-term chart. And in fact, it's a 5-year. If I bring it down even to the 3-year, you still see we still have quite a ways to go. And if anything, we're doing an ABC up. And again, we're still looking at minimally getting up towards where the previous fourth wave was. Now, I'm not saying that we're making that connection, but that's kind of what I look for a lot. Fourth waves are pretty good, and you target them. But I'm actually looking for it to get above. What's above it? Another fourth wave. So my own analysis, not that this is anything really Elliott, but I see a lot of times they happen to represent resistance levels for an upside move. Right. So first we have this B wave. That should provide some resistance. Then we're going to go out and we have this. So I think we can get above 128. We do have natural resistance on a fib basis at 129. If we can get above that, we're going to have additional resistance at 134 to 135, 136. If we get above that, well, then we're heading up here. And that's the target. The target for minor C and intermediate wave B is 144.30. And unfortunately, folks, I got to tell you, once we get there, I'm looking for it to turn and come down. But guess what? Even in our markets, I went into detail about what could happen, and it could change the dynamic of this particular pullback that we're in. And I'm labeling them in an immediate degree over in the equity markets. But if we had to, it gets bumped up. And if it gets bumped up, it's getting bumped up to the cycle degree. It's like, well, why, Michael, are you bypassing the primary? Because the primary is already in action. So we'll consider that primary degree finished, and it also finished above it, the cycle degree. Now, that is not positive for short-term and mid-term in our markets. And I actually prefer not to see that right now, because that will turn something really ugly. That will throw this country into a recession. That will throw this country into even worse could come about. So I'm preferring that we do actually adhere to the intermediate fourth wave. I'm hoping that here in the bonds, we adhere to the intermediate B wave to the upside. It keeps everything, it really just makes it smooth. We get through the bumps and the grinds, but the overall strength of the country and the markets remain intact. What's happening right now it's like walking into a crowd, throwing your vest open and realizing that everyone around you now knows that you've got sticks of dynamite attached to yourself. That's what I think sometimes it feels like. That's what's happening in our markets. That we're suddenly we're up and we're rallying, we're doing things, everything's fine. Then somebody comes in, boom, I'm going to blow you all up. And that's basically what I think that the current administration is doing to the US economy and to their own personal feelings about what they think all of these countries have done to the United States. So they're willing to implode decades of work to establish trade agreements between all of these countries. And now I'm just going to ditch it all. And he so proudly just holds his chart up and talks about it. Look at this, look at this. Oh, yeah, we're going to go after all these people. Well, their models are quite flawed. We saw the huge mistake that the president's team produced with what the number for the Chinese tariffs that were being placed back to the United States. Somehow their model said 67%. So Trump immediately went, well, we'll raise them up to 34. What did China do? Well, they took it from 10 to 34. Not 67 down to 34, but from 10 up to 34. Well, we'll make sure that your mistake is okay. Retaliate with the same. So again, it's yeah, I'm not going to go into that discussion, but let's just say within our bond market, they're very sensitive. Interest rates are very sensitive to what's happening in the economy, what's happening globally. What is the demand going to be? Well, right now we're seeing the demand for bonds. Why? Because they're trying to lock in these rates. That's why. If there's this pounding, pounding, pounding at the door, lower the rate, lower the rate. Well, I want to lock in this one and get it as long as I can get it. So that's why we're likely to see very strong participation in auctions coming. And I'm talking T-bill auctions. I'm talking about note options and note and not options, note auctions. Because it's like, look, we all have savings, not all of us, but we work to have a savings account. We work to put money aside. We work for our 401ks. A lot of people have pretty decent sized 401ks. You want to put it in the market or you want to put it in the Treasury bill for the 8 weeks or 12 weeks or 17 weeks and get 4%. I'll do that any day of the week because I can drop 10% in the market, but this is locked for the term of the T-bill. You want a sure thing or you want to go on the risk? You're seeing this take place now, folks. So when we're talking about where's this money going when it's leaving the market, back to a safer investment. That's what's happening. Watch gold. Watch the bonds. See how you see them coming in. I mean, the other day, I think it was Thursday, the bonds were up 2. And on Friday, they ended up, I think they were even higher. Oh, of course, they were down 6 in the extra hour, but they ended up pretty solid again on Friday. If we continue to slaughter ourselves in the equity markets, we're going to see the bonds get purchased again. Flight to safety, they call it, right? Well, here's the bottom line. Think about what the rate is. What are they trying to lock in? Look at what the auctions are. Our Treasury Department auctions pretty much every single day, every week. There's so many T-bills because our need for capital to operate the country is pretty great. But so far, we're meeting that need. Government continues to go, well, we got to raise the debt ceiling because as a government, we can't run. Well, we are running. We just have a whole bunch of people that want to knock it down. If it ain't broke, don't try to fix it. And that's what he's trying to do. He's trying to fix something that's not broken based on fear. Now, I do grant it before you all send me in comments. I do know that, excess debt, national debt ain't good. But right now, the safest place for money, well, up until this point, has been the United States. That's why our deposits are from everywhere. Last thing I want to remind everybody about here in this bond market, and that's what I'm going to be looking for when this gets up to the top of wave B. What can produce a C wave? There's only so far I think we can push China or push other large debt holders. In other words, they're holding US debt in the form of bonds, notes. When we auction, they show up. Here's $1 billion. Here's $2 billion. Here's the money. China, largest holder of US debt. Germany, European Union, very large holder of US debt. Canada, large holder of US debt. Can't speak for Mexico, I'm not that familiar. Japan, large holder of US debt. That's why the dollar continues to trade as the international currency of trade, because we're kind of everybody's largest trading partner until recently. Anyway, here we are, 30-year bond. I expect it to kind of go up. Resistance right now, 2207, 12207. Then we have 125.17. That's on the weekly, the 3-year weekly. If I can break this down, if you needed to, I don't advise, well, you might trade them on a much shorter term basis. See, not bad. 1, 2, 1, 2, 3, 1 of 3, 2 of 3. We're in a 3 of 3 move. That's my guess. That's my thought. So I think we should go above here. We might pull back, which we did start. We go to 122.07 and we should keep on going. Now, where else can I probably could fill it in, but just safe to say that we're at 122.07 and then we can just come out this direction and look that we have some more at 126. So there really isn't all that much in between 122 and 126. And then we have 128 and then we have 129. Ultimately, going back out to my 3-year weekly, I do think we get above 135, or as a minimum, I would like to see wave C at least get to 135. Ultimately, I'd like to see it get to 144. Now, what is it going to mean for the yield? Well, 3.5, 4, 3.5, 3.5 is what I meant to say. Maybe even less, 2 3/4. Okay. But we're going to have to be in an economy that's kind of operating on all cylinders, not limping, not dying on the vine. All right, so that's the 30-year bond. Let's go over to the 10-year note, which is the one that everybody says the Fed likes to look at, and that's true. All right, again, here as well, 3-year. Let me go back out to that 5-year, because I can show you that. There was a tie. 0.00, it's got that little sign in there, but it's 0.069, 0.69, excuse me. 0.7% was the interest rate for 10 years on these notes back in 2020. And we got the backlash. Ding, 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 ding. And down here, the rate was, I think on the 30-year bond, I think I saw 5%. And here on the 10-year note, I think it was 4.5 to 4 3/4, maybe even 5. I think it did actually get above 5 once or twice. Then we put in intermediate wave A. And now we're in intermediate wave B. And the same thing, except this one put in a 3-wave A. So B kind of came down as a flat. So it's a little bit different, but I'm looking for a nice C wave up. So if I said ABC ABCB, and now we're doing 5. And this one a little bit cleaner. 1, 2, 3, 4, 5. Maybe that's 1. We pull back into 2, and then we start to go. We got above 0.618, which is pretty nice. We got the high last week was 114.035. That's pretty nice. That's a pretty good rally, considering we were coming off of 107. Go back to 114. Nice job, bond market. Nice job. And I'm thinking that's going to continue. Our next strength will be tested at the 3-year weekly 200 at 116. That should provide some stiff resistance. It gets us above that level, which is something. That would be great. But if we bonk our head up on there a little bit, we might pull back, but eventually we should break, get above 117, 118, might provide additional stronger resistance, but that takes us above that 4, and that would be very good. See, that 4 and this 100% kind of match up a little bit. So it's going to be bonking its head before we get above it. Then we get above it, and that should clear the path to get us up to this next level, which is 122. And ultimately, 1.618 is 123.295, and that would be for the C wave. But I think 122 would be pretty nice job. Well done. And then we'll go from there. So in essence, what am I trying to say here? I think the bond market left alone will take care of the lower rates you desire, Mr. President. They won't be as announced like the Fed cutting rates, but the market may do it for you. And then you're going to have it via your 10-year note. So let's see what happens. I know it's been a while, but you can see market's been kind of bouncing around in a range since October of 2023. This high was September of 24, and this low was January of 25. So we have for 2 years kind of just been hanging out in a very small, tight trading range. And that even spooked me a little bit, like, oh my God, I was at the B wave here, and now we're just going to go and go and go, which would have suggested that the 10-year goes below par, which is 100. Interesting market all the way around. Let's see what happens. Forecast: lower interest rates, higher note rates or bond prices or treasury prices. And that should be across the board. What, we got something in the brew? Keep an eye on that 2-year note versus the federal funds. The Fed funds in the 2-year note. Are we starting to invert the wrong way? I hope it corrects itself. All right, that's all I'm going to do for today. I'm just doing the 10-year note and the 30-year bond. We have 5-year notes, we have 2-year notes, and we have T-bills. We got a lot of stuff that gets auctioned off all the time. All right, I will try to keep these also updated. But I'm a one-man shop here, guys. So I get it when I can get it done. And this weekend, I've done 1, 2, 3, 4, 5, 6, 7, 8, 9 markets I've updated. So I'm pretty pleased with myself. Hate to be that way, but I am. So in any case, we got Globex is getting ready to start in about 45 minutes. I want to be ready for that. So I'm going to continue to say this is it for this market and for the 30-year for the Treasuries. And let's keep an eye on it all. So next update, hopefully I'll at least be able to do these weekly.